DAV Magazine. For more information, visit davma.org. That's davma.org.
Beneficiary planning and asset protection go hand in hand, but leaving everything to your kids can be problematic. Call Cushing & Dolan at 866-848-5699 and get their new guide called How to Leave Assets to Your Beneficiaries. Don't leave your future or your children's future to chance. Call 866-848-5699 or request it online from our website, LegalExchangeShow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
We are the Debt Destroyer Network. Any debt you have, credit card, tax, student loan debt, call now for free information that helps you destroy your debt. It's great advice. Plus, when you make this free call now, we have Debt Destroyer experts ready to help. They can show you how to destroy your debt and get your life back on track. Debt problems don't have to be overwhelming. You can live stress-free and debt-free. Credit cards, medical bills, IRS tax problems, even student loan debt. Learn about free programs offered by the credit card companies, hospitals, and even the government that can help slash your debt. Call the Debt Destroyer now for free information. Call now. 800-430-8804. 800-430-8804. 800-430-8804. Again, that's 800-430-8804.
Hi, this is Chuck and Mike from the Armstrong Advisory Group, and our guide this month is titled Preparing for an Upcoming Retirement. Mike, what kinds of things do people need to look at to know whether or not they can undertake a successful retirement?
Yeah, I mean, first steps first, we talk about your income sources in retirement versus your expenses. And usually the easiest thing today is to look at what are my income sources now, how will they change, and what are my expenses now, and how are they likely to change. On the expense side, oftentimes it's not that big of a change, but I think that's the first starting point before getting into more complicated things such as my investment portfolio, my health insurance situation, or Social Security strategies.
Mike, a lot of times people are concerned about whether they have enough to live all the way through retirement, and so they might delay their retirement significantly. But it's also worth pointing out that sometimes the biggest risk is not retiring early enough, and you might miss out on some retirement years that way.
Yeah, I mean, look, we all do get worried about longevity, and there are plenty of warnings out there in the media about how Social Security or these other things might not keep pace. But man, it sure is devastating to see the opposite one, where you work your whole career, work your tail off, save all this money, and it can impact your health. It can impact all sorts of things. And to not get to enjoy that full retirement because you choose to work longer than you might have needed to is so much more frustrating.
Our guide this month is titled Preparing for an Upcoming Retirement, and there are two ways you can request it. The first is by calling 800-393-4001. The second is by going to ArmstrongAdvisory.com. That phone number again is 800-393-4001, or you can visit ArmstrongAdvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. The U.S. Virgin Islands is St. Croix, St. Thomas, and St. John. Visit one or all three and enjoy the vacation of a lifetime. Each island is special in its own unique way. So whether you want the heritage of St. Croix, the pristine beaches of St. Thomas, or the calm and relaxation of St. John, the U.S. Virgin Islands is one of the top vacation spots to visit in the Caribbean. You can expect perfect temperatures, a wide variety of water sports, world-class cuisine, and a vibrant nightlife. From the moment you arrive, you'll fall naturally in rhythm with the heartbeat of the islands. There's no money to exchange, and travel from New England could not be easier. Make your plans now by going to visitusvi.com. Learn about all three islands and plan the ideal vacation for you and your family. America's Caribbean paradise is waiting for you. So head to visitusvi.com for more information and to reserve your trip today. That's visitusvi.com. The Financial Exchange is produced by Money Matters Radio and is hosted by employees of the Armstrong Advisory Group, a registered investment advisor that provides investment advisory services. All opinions expressed are solely those of the hosts, do not reflect the opinions of Armstrong Advisory or anyone else, and do not guarantee profit. Investments can lose money. This program does not offer any specific financial or investment advice. Please consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong and Money Matters Radio do not compensate each other for referrals and are not affiliated. This is the Financial Exchange with Mike Armstrong and Marc Fandetti. Your exclusive look at business and financial news affecting your day, your city, your world. Stay informed and up to date about economic and market trends, plus breaking business news every day. The Financial Exchange is a proud partner of the Disabled American Veterans Department of Massachusetts. Help us support our great American heroes by visiting DAV5K.Boston and making a donation today. The DAV 5K Boston is presented by Veterans Development Corporation. This is the Financial Exchange with Mike Armstrong and Marc Fandetti.
Happy Friday and welcome back to the Financial Exchange. We started the day yesterday with kind of scratching our head, not sure where to start given all the news that was coming out. And same story today. Last night we heard from two major tech companies making up $5 trillion worth of combined market capitalization. That would be Microsoft and Google. Parent company Alphabet will be talking about their earnings and how they contrasted or compared with Meta's earnings, Facebook's parent company. We also got a new set of inflation data this morning from the Bureau of Economic Analysis, the PCE inflation reading, which is the Federal Reserve's preferred measure of inflation. So let's start right there, Mark, because I know we've got our stack. I know that CNN put the word stagflation in one of their headlines today, so that's being talked about again after the GDP report that came out this week. And like it or not, that's potentially going to be the word of the next few weeks here as people digest some of this data. So let's start off not talking about stagflation, but rather about the data that came out just this morning. This is like I said, the data from the Bureau of Economic Analysis on inflation. And what did it show us, Mark, in general?
Well, there is a stagflation element to this. Stagflation, I know you said let's not talk about it, but I have to define it since you brought it up.
Yep.
It's obviously a hybrid of stagnation and inflation. It was coined in the 70s. It means slow growth and high price growth, slow economic growth coupled with high price growth. GDP yesterday, we learned in the first quarter, slowed relative to last year. It grew at about half the pace,
and
according to the first estimate. Yeah, so few saw it. Our internal models nailed it. They don't always, but few saw it coming. Look, the bottom line is when something grows above trend for a long time, predict it's going to revert to trend slightly. So no real magic there. Anyhow, so this stagflation worry arose as a result of that report. But the report we got this morning, which showed inflation month over month using the personal consumption expenditure, so-called PCE deflator. I'll just call it the PCE index. 0.3% month over month, whether or not you strip out energy, same number. If you annualize that to get a sense for how that might unfold at present pace, you get more than 3.5%. The Fed's goal is 2%. So on its surface, the report is, though 0.3% month over month was expected, it's still a disturbingly high annualized rate over the last 12 months. Not a great measure to look at it because it's a lot of this stuff is based on past economic activity in the 12-month figure. But over the past 12 months, the PCE index rose. Again, I'm talking headline here, not ex food and energy, 2.7%. Again, the Fed's goal is 2%.
Yep.
So no matter how you slice this, whether you look at month over month and annualize it the last few months and annualize those for either core or headline, or the last 12 months, you're looking at inflation that is significantly above the Fed's goal, and that probably shouldn't surprise as the economy continues, according to this measure, to run hot. Spending up, income up. And we'll talk about some other aspects of this which suggest continued strong economic growth.
Yeah, so I think that key takeaway that you mentioned, the headlines always print the year-over-year number, and that's reasonable only insofar as it's easier to understand what we're talking about when I tell you that prices are up 2.7% compared to this time last year versus, prices moved up 0.3% month over month. It's really difficult to understand whether or not that's a lot when you just take it out of context. And so that's why the year-over-year number gets reported. But to your point, I agree that's not the most important because that's just so backward looking, right? The economy a year ago is not the same economy that we have right now.
Different people use these figures for different reasons.
Sure.
As consumers, I am interested in how much the cost of living has gone up over the last 12 months. It's going to affect the wage increase that I ask for. It's going to affect my perceptions generally. But if you're, say, an economic researcher, you're more interested in measures that, A, capture the trend, underlying inflation, which the Fed is responsible for, and measures that inform, if you do this type of thing, measures that inform your forecasts.
So the disheartening piece to me is, we always say, maybe discount 1 month of data or a single data point. But today now we have data on inflation for the month of March from 2 different sources. So first we had it from the Bureau of Labor Statistics. They give us CPI, the Consumer Price Index. Now we have data from the Bureau of Economic Analysis on personal consumption expenditures. Yes, they measure different things, but that's good because we want a well-rounded view of inflation. And so if I'm taking a look at both of these data series for the last 3 months, and I just annualize those data series, which, again, I don't know if that's the perfect way to look at it. Maybe we should look at 2 months, 6 months, 1 month. I'm not sure. But if we take a look at the last 3 months and annualize those numbers, the lowest number that I get to on either core or traditional inflation readings is 4.0% annualized. The highest number is 4.8. So no matter how I cut this data, it seems to me that the last 3 months of inflation data is running about double or more the Fed's target.
And it's worth pointing out that policymakers thought as recently as a year and a half ago that we'd be back to target by now.
Yeah.
So the phrase stubbornly high inflation is used a lot, maybe overused, but it applies. Policy was too loose early on. The big question is it tight enough now? Have we given Fed hikes, which terminated in July of last year, enough time to work their way through the economy? That's an open question.
Yeah, so the term stagflation, like you mentioned, has been tossed, or like I mentioned, has been tossed around now. Jamie Dimon didn't use the word, but made a statement, I think yesterday or the day before, that today's time period is looking more and more like the 1970s than any other period in history. And I guess, my question for you, Mark, is, do you buy that comparison at this stage of the game?
Well, it's the only other peacetime inflation in the post-war period. I'm mixing definitions there a little bit, but it's the only peacetime inflation we have to refer to. And there are some unnerving parallels. It was the 70s were the result of the late 60s expansion of spending on both the Great Society and the Vietnam War. Mm-hmm. Johnson put pressure on Fed Chair Martin at the time to not hike rates. Martin did it anyway, but Martin left in 70.
Yep.
Nixon put his friend Arthur Burns, an acclaimed, by the way, economist. Arthur Burns gets a very bad rap in the annals of monetary policy history.
For a pretty good reason.
But he's like the Larry Summers of that period, brilliant business cycle theorist and practitioner. Nixon said, don't raise rates, Arthur. Mm-hmm. And Burns stopped the Martin hiking policy. Inflation picked up. So I'm talking core inflation, underlying inflation.
I understand.
Then you couple that with OPEC 1, OPEC 2. So it was a series of supply shocks. There were food price shocks, the famous anchovy shortage, which I guess chickens eat, and it drove up chicken prices. It was the economy took one kick in the pants after another during the 1970s. Mm-hmm. What didn't help the situation, though, is that underlying inflation was elevated because lack of Fed resolve. And you do get this feeling that we are repeating that error. The Fed hasn't been resolute enough, didn't raise rates quickly enough.
Yep.
Did they raise rates to a high enough point? I don't know the answer to that. We'll know in a year, maybe. But you get the sense from their remarks that they're very eager to cut rates, which makes me a little bit uncomfortable.
So, I think important when we're talking about the comparisons to the 1970s and stagflation to recognize that, look, we don't have any other comparisons, right? So if you have high inflation, then you're automatically going to compare to the 1970s. It's also fair to say that not as much has gone wrong yet in this U.S. economy than did in the 1970s. But it also lasted a decade, and we're just in the first year or two of
there's
this.
This really interesting historical take on it by a guy named Brad DeLong, who's a professor of economics. He's kind of famous. The Fed didn't have the mandate to fix inflation until it really got out of control. Paul Volcker would not have been able to do what he did had he been appointed 5 years earlier.
Right.
People weren't fed up enough yet. And I'm wondering if people are fed up enough to instigate real change in the way the Fed, and by the way, the answer to this is not to politicize the Fed. The answer to this is not to give a president or senatorial committee or anything else, and we're going to talk about that story.
Yeah.
But the answer to this is not less Fed independence. It's to appoint governors and chairs who have a better understanding of monetary economics and who are more committed to price stability than they are worried about a slight uptick in unemployment.
Let's. I want to take a quick break because we've started now to allude to something that the Wall Street Journal broke this morning, which is probably making big ripples in economic circles and just about nowhere else. So we're going to take a quick break, and then when we come back, we're going to talk about Federal Reserve independence and why it is potentially so important and in the news today. Quick break. We'll be right back with that next on the Financial Exchange.
This is your home for the most comprehensive coverage of the economy and the trends on Wall Street. This is the Financial Exchange Radio Network.
If you're one of the millions of Americans at or nearing retirement age and you don't have a solid plan, it may be difficult for you to enjoy your retirement years. Hi, this is Chuck Zada from the Armstrong Advisory Group, and I've got some questions for you that may offer some guidance as to whether now is the right time for you to retire. Can you retire? Do you have enough money to live the way you'd like to? Should you retire, or have you exhausted your time in the workforce? Regardless of the answers to these and other questions, our new guide called Preparing for an Upcoming Retirement can provide some insight that may help you make the right decision. Call 800-393-4001 to request your free copy of the guide and get a head start on building your retirement plan. That's 800-393-4001, or you can request it online at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. The U.S. Virgin Islands is St. Croix, St. Thomas, and St. John. Visit one or all three and enjoy the vacation of a lifetime. Each island is special in its own unique way. So whether you want the heritage of St. Croix, the pristine beaches of St. Thomas, or the calm and relaxation of St. John, the U.S. Virgin Islands is one of the top vacation spots to visit in the Caribbean. You can expect perfect temperatures, a wide variety of water sports, world-class cuisine, and a vibrant nightlife. From the moment you arrive, you'll fall naturally in rhythm with the heartbeat of the islands. There's no money to exchange, and travel from New England could not be easier. Make your plans now by going to visitusvi.com. Learn about all three islands and plan the ideal vacation for you and your family. America's Caribbean paradise is waiting for you. So head to visitusvi.com for more information and to reserve your trip today. That's visitusvi.com.
Building a solid financial strategy is a core element to enjoying your retirement years. That's why you need advice that you can count on. At the Armstrong Advisory Group, we understand the challenges of positioning your assets to help you maintain your wealth over time. Our goal is to offer advice that is both suitable and in your best interest. When you hire one of us, you hire all of us so you can be comfortable knowing that every advisor in our firm is dedicated to helping you create a realistic plan for your later years. Visit us today at armstrongadvisory.com and sign up for a free, no-obligation planning session. Click the Get Started button at the top right corner of the homepage, and you can select the day and time that works best for you. Go to armstrongadvisory.com and let us help you secure your financial future. That's armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
Environmental nonprofit Ocean River Institute is working with communities to tackle climate change with nature-based solutions that feature slowing water down and building more soil with grasses and plants. Research indicates that people acting in their own neighborhoods can build an inch of soil in a year and slow sea level rise down by as much as 25%. Please visit oceanriver.org for more information on opportunities to make a difference and go the distance for savvy stewardship of a greener and bluer planet Earth.
For 40 years, Cancer Support Community has been a relentless ally for anyone impacted by cancer, with free services provided online and in person, with their newest location in Massachusetts. Connect with Cancer Support Community Massachusetts for free emotional support, educational resources, patient navigation, financial counseling, and more. 617-797-3391. CancerSupportMass.org. CancerSupportMass.org.
The Financial Exchange Show podcast drops every day on Apple, Spotify, and iHeartRadio. Hit that subscribe button and leave us a 5-star review. You're listening to the Financial Exchange Radio Network.
The Financial Exchange has built an incredible partnership with the Disabled American Veterans Department of Massachusetts. We can't wait to take part in this year's DAV 5K, set for Saturday, November 9th at Fort Independence on Castle Island. Registration's now open. You can help our great American heroes by walking, running, or simply making a donation. Your gifts will support services such as the Veteran Advancement Program, which offers permanent and affordable housing opportunities for veterans and their dependents. Learn more at dav5k.boston. The DAV 5K Boston is presented by Veterans Development Corporation.
Piece in the Wall Street Journal today that I believe was a Wall Street Journal exclusive. Trump allies drawing up plans to blunt the Fed's independence. Quoting from the article here, a number of the president's allies, quote, whose work is so secretive that even some prominent former Trump economic aides weren't aware of it. I don't know how it's so secretive that we're reading about it in the Wall Street Journal, but nonetheless important story to discuss. Now, the allegations here are that these members of Trump's inner circle are working up plans to remove the head of the Federal Reserve and replace Jerome Powell with somebody presumably more dependable to the president's way of thinking on interest rates. And like you said, we have a pretty good example of this in the 1970s with Arthur Burns. And the result that we had there, which, again, maybe fair to say you don't have the full context back then of the impact on interest rates and inflation.
That's true.
But the result was a nearly decade-long period
Chronically
where
bad policy.
Growth was abysmal and
growth wasn't horrible. No, this is a surprise
different
to me
periods
too.
of time.
Every time
Yeah.
But no, nobody remembers the 70s economically fondly.
It was, I guess, defined by a period of time where nobody had any idea where prices were going on a year-to-year basis.
Yeah. Fed was partly flying blind. Look, again, Burns was a brilliant guy, but he had the political pressure coming from Nixon. Didn't always give into it. Mm-hmm. The history of the period, by the way, is really interesting if you're into monetary policy, which I know most of you are not. So I'll sum it up by saying, like Mike basically said, it didn't end well. The pressures on Burns, the political pressures coming from Nixon, who appointed him and who was his friend, coupled with the lack of understanding, Mike, like you said, which is not a point a lot of people make or understand, the relationship between so-called monetary aggregates, which is a fancy way of saying money supply, and the economy were not well understood. They still aren't, but they were even less well understood then. The Fed didn't raise interest rates to squash inflation the way it does today. The relationship wasn't understood to be as clearly as we think we understand it today. And then, again, the supply shock, so a lot of bad luck. But the bottom line is nothing good in any developed country has ever come from increased political meddling in the supply of money.
So good example here, go take a look at Turkey. President Erdogan basically controls interest rates there. And his solution to terribly high inflation in the double digits was let's lower interest rates and stimulate the economy.
It's impossible to resist if you're a political figure.
Yeah, exactly, because lower interest rates fundamentally spark growth. They allow people, the stock market to appreciate. They allow people to buy homes. A good feeling when you are dealing with that. The problem with low interest rates during a high inflationary period is it prompts more inflation in all likelihood. We have pretty concrete evidence of this. And I guess my point with all of this, so the Federal Reserve in the United States, I know you and I myself have had plenty of criticism of Jerome Powell and his actions taken over the last few years.
A Trump appointee, by the way. You might start with making better appointments rather than injecting yourself into the process.
So plenty of criticism there. But one thing I will not criticize for this Federal Reserve for is succumbing to political pressure. I think that is one area that they have done exceptionally well to push back from that and say, we will not allow that to happen. We make the quote from Powell in 2019 was, "We're human, we'll make mistakes, I hope not frequently, but we won't make mistakes of integrity or character." And so just to finish this thought, even if you personally believe that Donald Trump knows more about economic policy and the right thing to do on interest rates than Jerome Powell and the Federal Reserve, which I'm sure people believe. I'm sure that people believe that that is the case and that he would do a better job of laying this out. He needs to disavow this because of the precedent it would set.
He won't, because I think he believes it.
I know he won't. But even if you, again, believe he is the almighty savior of this economy and we'd be better at central banking, he will not be the president for the next 100 years. And so what you are instead doing is politicizing an institution that only works because it does not conform to political pressure.
So why is independent central banking valuable? Because it insulates them, as you say, from political pressure. Every study, every serious, well-done study that's looked at this here and elsewhere has concluded that independence is good for price stability because they're not going to try to goose the economy in advance of an election, and they're going to do what's necessary, as Paul Volcker did. Reagan was very critical of Volcker. Schultz was very critical of Volcker, Secretary of Labor at the time. But they didn't do it publicly. They kept there. And Clinton was the model for not criticizing. Even George H.W. It cost Greenspan's failure to lower rates quickly after the 91 recession cost George H.W. the election in all probability. He didn't say a word out loud. So my point is not to give a history lesson, which I'm really not qualified to give. My point is it took us about 50 years to settle on the importance of central bank independence and for us to agree as sort of a societal norm that it was a desirable thing. To wreck it in just a few months would be, the height of irresponsibility.
And again,
I hope this isn't a serious idea.
Yeah, I hope not as well. The allegations are pretty serious. And again, for anyone that gives two damns about the future of the American economy, you should insist that this gets disavowed and gets thrown in the trash as a stupid idea. Again, because I really need to reiterate, I don't care who you think should be in power or shouldn't, or who has better ideas about the economy. The fact of the matter is, if you do away with central bank independence, then you do away with it permanently. If you make it so the executive can remove the head of the central bank of the United States, then the next president, who you probably won't agree with, will do the same thing, and then you have this revolving door of probably what it leads to is artificially lower rates, much higher inflation, much bigger problem with deficits, and an economy that, spirals into higher inflation for a longer period of time. That is the risk that you run with all of this. Maybe good results in the short term. Maybe you could have the stock market take off. You could have the housing market take off. You could have an employment drop. Could be really good results in the short term. And you'd be sacrificing what I would estimate would be terrible results in the long term.
I mean, if you're upset with inflation, the solution is tighter, not looser money.
Yep.
Neither presidential candidate, neither Trump nor Biden, will advocate for higher interest rates. They'll say give current rates more time to work.
Let's take a quick break here. When we come back, we're going to have a full market update after yesterday's sell-off. What are stocks doing after the big earnings reports from Microsoft as well as Google? That's coming up next.
Like us on Facebook and follow us on Twitter @TFE Show. Breaking business news is always first, right here on the Financial Exchange Radio Network.
If you're thinking seriously about retirement, now's the time to build a sound plan that will help you enjoy your later years. This is Mike Armstrong from the Armstrong Advisory Group, and if you're one of the millions of Americans at or nearing retirement age, it's important to understand how to develop this plan, and our new monthly guide may help. In it, we discuss strategies to prepare for an upcoming retirement. We'll walk you through the process of putting together a retirement income strategy, exploring your healthcare options, and managing potential financial risks. There's also the crucial issue of maximizing using your Social Security benefits. Call our office today at 800-393-4001 and get your copy of this new free guide, Preparing for an Upcoming Retirement. That number again is 800-393-4001, or you can request it from our website, armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. The U.S. Virgin Islands is St. Croix, St. Thomas, and St. John. Visit one or all three and enjoy the vacation of a lifetime. Each island is special in its own unique way. So whether you want the heritage of St. Croix, the pristine beaches of St. Thomas, or the calm and relaxation of St. John, the U.S. Virgin Islands is one of the top vacation spots to visit in the Caribbean. You can expect perfect temperatures, a wide variety of water sports, world-class cuisine, and a vibrant nightlife. From the moment you arrive, you'll fall naturally in rhythm with the heartbeat of the islands. There's no money to exchange, and travel from New England could not be easier. Make your plans now by going to visitusvi.com. Learn about all three islands and plan the ideal vacation for you and your family. America's Caribbean paradise is waiting for you. So head to visitusvi.com for more information and to reserve your trip today. That's visitusvi.com.
If you served in the Marine Corps, by now you know about the contaminated water problem at Camp Lejeune. If you were stationed or worked at Camp Lejeune from 1953 to 1987, you probably have a lot of questions. We have some answers. You could be entitled to compensation. Billions of dollars are being allocated to pay for damages to anyone stationed at Camp Lejeune during that time. Unfortunately, it appears that officials may have known the contaminated water problem existed and did little to protect their men. The Semper Fi Code was not honored. If you or someone in your family has developed a serious illness, including various forms of cancer, call this Camp Lejeune legal support line right now. You can't turn back the clock and change what happened, but you can certainly call right now and learn your rights as a Marine. Here's the number.
800-477-1736. 800-477-1736. That's 800-477-1736. Paid for by Legal Alert Line.
This is Tucker Silva of the Financial Exchange Show, and I'm joined today by estate planning attorney Todd Lutzke from the law firm of Cushing & Dolan with your Financial Exchange quick tip of the day. And today we're talking about your brand new guide, Todd, how to leave assets to your beneficiaries. Todd, how can you ensure that your kids' inheritance can be protected from future divorces?
Well, estate planning, as you know, does things like avoid probate, protect assets from nursing homes, and reduce taxes. But you know what? The family behind the estate plan can be more important. And so the trusts live on after you die, and you can have language in there that divides the assets to the children, but doesn't just pay it out, right? It holds it in trust for them and allows them to be trustee, but just not take it. In order to get it, they have an independent trustee that can say yes or no. And that way, by not owning the asset, if they get divorced down the line after you're dead and the other side says, hey, I want half of what's in that trust, you're going to say, that's great, but you have to ask the independent trustee. So it's now not going to be available to you. And more than just the ability to say no, it's the fact that you don't own it. So if you don't own it, it's not a marital asset to begin with, so it should not be even subject to the divorce. So learning how your trust works after you die can oftentimes be more important than when you're living, and it does more for you after you die than when you're living sometimes.
The estate planning experts at Cushing & Dolan have been helping families like yours for more than 30 years, and they've written a brand new guide called How to Leave Assets to Your Beneficiaries. To get your free copy of this comprehensive guide that will help you determine the best way to leave assets to your family, simply call 866-848-5699. That's 866-848-5699, or you can request it from their website, legalexchangeshow.com.
The proceeding was paid for, and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing and Armstrong do not endorse each other and are not affiliated. Time now for Wall Street Watch. A complete look at what's moving markets so far today, right here on the Financial Exchange Radio Network.
Well, following yesterday's sell-off, markets today are bouncing back as Google and Microsoft are helping drive the tech sector higher. Following their first quarter earnings, Wall Street's also sifting through a slightly hotter than expected core PCE index unveiled this morning. Right now, the Dow is up by nearly 200 points, just over 0.5%. S&P 500 is up just over 1% or 52 points. And the tech-heavy Nasdaq up nearly 2% higher or 290 points. Russell 2000 is up 1% as well. 10-year Treasury yield is down by 5 basis points, now at 4.65%. And crude oil is edging higher, trading at $83.73 a barrel. Shares in Alphabet and Microsoft jumping by 9% and 2.5% respectively after the tech giants reported better than expected first quarter results. Alphabet also announced its first cash dividend. Mike and Mark will have more on both of those companies in the next hour. Meanwhile, Intel shares dropping by about 11% after the chipmaker reported a first quarter loss and offered a disappointing outlook due to its multi-year turnaround effort. Intel's revenue did, however, climb 9% for the quarter, following a recovery in the personal computer market. Elsewhere, Snap posted a 21% revenue growth in the first quarter, well past street forecasts in addition to its own guidance. Snap shares up by 22%. And in a follow-up to news yesterday, Anglo American officially rejected a $39 billion takeover bid from competitor BHP, saying the proposal undervalues its shares. Anglo's stock is up by about 3%, while BHP shares are down by 2%. I'm Tucker Silva, and that's Wall Street Watch.
Mark, we've talked at length about how, in spite of fundamentally what appears to be an improving economy compared to 2022, whether you look at inflation, unemployment, the stock market, any of those things seem to be showing, market improvement. Responses to surveys about how people feel the economy is doing remain pretty abysmal. Maybe, slight improvements from where we are again in 2022, but still not great. So the Wall Street Journal has come up with the perfect solution. They've been working with the American Academy of Arts and Science to get a broader measure of what the economy is doing. And I think I'll first say that we should not correlate what GDP and the Dow are doing, which is the case that the Wall Street Journal is making here. We should not correlate to that to how the average household is doing. The two have nothing in common. GDP does not tell you anything about American individual wealth or household wealth. It just tells you a broad measure of the economy. It doesn't tell you anything about the distribution of the wealth. How about that? Is that a fair statement?
It is not meant to.
Wasn't designed to and shouldn't be interpreted as doing so, nor
we
should.
We have other ways to measure that, but yeah.
Right. So this is just one more of them, and I have no idea how to judge this one versus other measures. But it does try to take a more broad view of the overall economy. What does it do? It measures 4 central elements: economic security, economic opportunity, health, and political voice. And they have a bunch of different ways of measuring this without going and asking people questions, which is what I like, because I think that, generally speaking, I think when you go and ask people questions about the economy, you get politics that influences too much here. And so, again, whenever somebody creates a new index like this, I have no real way to judge it as better or worse than any of them, but I will just generally talk about it. Nationally, according to this newly created score, which they're calling CORE, they have seen little improvement in American well-being since the data began in 2005. Health scores, for instance, have climbed substantially mainly because of healthcare coverage expansion, but those have been offset by a decrease in measures of economic security. The District of Columbia, according to the score, has the highest state-level core score for 2021. That's followed by Rhode Island and North Dakota. And also follows a trend that shows that, in terms of financial security across the country, the Northeast and upper parts of the Midwest boast some of the highest scores. But again, we just don't have enough of this data to judge whether this is the perfect scorecard for anything. And I don't know that it's inherently better or worse than any other measure of economic well-being.
Yeah, I guess to see if it's meaningful, and these guys are serious academics, with Ivy League credentials and backgrounds, so they know how to do research. You'd have to, number one, and they've probably already done this, I'm sorry if I missed it, but how well does it correlate with, does it co-move with other measures of economic well-being? Does it zig when GDP zags? If so, it might be telling us something different. I'll pause. Did you detect any of that here?
No.
If not, I have a follow-up.
Yeah, I have not looked at it to say, does this correlate with anything at all? Michigan sentiment, GDP.
So that'd be a first step. And these guys are
measures.
serious researchers. They know to do this sort of first step. If you were trying to get this vetted by your peers and then established somehow as a way to gauge well-being in some vague sense. The other, I guess, way to test whether or not this measures well-being is to look at peaks and trough relative to electoral results and turnover. When this thing is low, do presidents get thrown out? Is there turnover in Congress? Right. Are people acting on their discontent as measured by this survey? Again, these guys are serious researchers. It sounds like an interesting methodology, and I see nothing wrong with trying to...
On the surface, my biggest concern with it is that if I look at the line that they drew for their data from 2014 through 2021, there's no change. It's basically flat for that entire time period.
Yeah.
And we had pretty different economies in 2014 compared to 2021. And so if you've created a tool that basically just tells me that the American well-being has flatlined and doesn't change on a year-to-year basis, then I'm not sure how useful
Look,
that
we
is.
are objectively speaking, we're wealthier, full stop. You can't dispute that.
Sure.
But does that translate into vaguer things like happiness and well-being? The answer is no.
And I think that's what this is trying to get
We've
at.
known that. Economists, they set up a bit of it was the journalists who wrote this, not the guys who did the research, who, again, are top-notch researchers. I don't know their work, but I look at their academic backgrounds and say, these are serious people. No economist has ever claimed that GDP was a measure of well-being.
Right.
No one claims that. No one claims that the rate of unemployment
Well,
or the
I'm
rate
sure
of
some
inflation,
poorly written journalistic pieces.
probably, but those are
trying to
people,
correlate
these are
GDP to
journalists, not
well-being.
people who actually work with data and understand its limitations, which you have to. No one makes that claim, but it's all we've got right now is GDP, per capita income, and other measures of overall economic health. You just can't use these tools for things that they weren't intended to identify or questions they weren't intended to answer.
So anyway, I intend on following up on this because I find it interesting. And again, the reason that I like something like this, and I don't know how they've built it and what it's actually going to measure in the future, but it's not based on asking people questions about how they feel about things. It's instead based on, when they look at political voice, right? They're looking at how often do their elected officials vote based on polling in the area on certain issues. How much representation do they have? Things like that. Those are things that are pretty fundamentally important to how people feel about things.
Look at the rise in populists on the right and on the left. The change in the political complexion of this country over the last 20 years is on its face evidence that something isn't right. This is not the stable, predictable set of back and forth type relationships. I'm talking politically now that I remember from the 80s and 90s. I was just a teenager in the 80s, but the 90s I remember vividly, and even the 2000s up until the Iraq invasion, which was 2003, so early on. Things, of course, unraveled dramatically starting in 2007 and 8. So the political complexion has changed to reflect that. We've got populists running on the left and right for president. This is not something I would have imagined 20 years ago. So I don't, I'm not surprised by the results of this. They confirm that
people are dissatisfied and don't feel like progress has been made.
Something
over the last 2
feels
decades.
broken relative to the consensus of the 80s and 90s. I think everyone listening probably picks up on that.
Let's take a quick break. When we come back here, I want to talk a little bit more about the Federal Reserve, not their independence, but rather the likelihood now of an interest rate cut this year and what that might mean for stocks, bonds, real estate, everything under the sun. Quick break. We'll be right back on the Financial Exchange.
Missed one of our shows? Catch up anytime by asking your Alexa smart speaker to play the Financial Exchange. This is the Financial Exchange Radio Network. The U.S. Virgin Islands is St. Croix, St. Thomas, and St. John. Visit one or all three and enjoy the vacation of a lifetime. Each island is special in its own unique way. So whether you want the heritage of St. Croix, the pristine beaches of St. Thomas, or the calm and relaxation of St. John, the U.S. Virgin Islands is one of the top vacation spots to visit in the Caribbean. You can expect perfect temperatures, a wide variety of water sports, world-class cuisine, and a vibrant nightlife. From the moment you arrive, you'll fall naturally in rhythm with the heartbeat of the islands. There's no money to exchange, and travel from New England could not be easier. Make your plans now by going to visitusvi.com. Learn about all 3 islands and plan the ideal vacation for you and your family. America's Caribbean paradise is waiting for you. So head to visitusvi.com for more information and to reserve your trip today. That's visitusvi.com. Beneficiary planning and asset protection go hand in hand, and Cushing & Dolan, the experts in elder law and taxation, can help make your planning process smooth and easy. Simply saying you're leaving everything to your kids isn't as simple as it sounds, especially if they have problems of their own. If you're retired or nearing retirement, it's time to consider the best way to keep your assets in your family while avoiding significant financial consequences down the road. Call Cushing & Dolan right now at 866-848-5699 and get their new guide called How to Leave Assets to Your Beneficiaries. You'll learn which paths are the safest when it comes to protecting yourself and your children while avoiding unnecessary risks that can cost you dearly in the long run. That number again is 866-848-5699. Or you can request it online from our website, LegalExchangeShow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
Millions of Americans are preparing for retirement. And if you're one of them, making sure you have a solid plan is the key to enjoying your later years. Hi, this is Mike Armstrong from the Armstrong Advisory Group, and I'd like to ask you 2 simple questions. Can you retire, and should you retire? Our new guide is called Preparing for an Upcoming Retirement, and in it, we'll discuss strategies that can help you answer these questions and others so that you can make the right decision for you and your family. There are many different elements to a sound retirement plan, including knowing how much income you'll need to live comfortably, when to take Social Security benefits, and understanding what financial risks might be worth taking. Get your free copy of our new guide, Preparing for an Upcoming Retirement, by calling 800-393-4001, 800-393-4001, or you can request the guide at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
To be engaged, you must feel included and valued. The DAV Department of Massachusetts nurtures a culture where inclusiveness is a reflex, not an initiative, where there's a deep sense of pride, passion, and belonging that is unified in our shared commitment, dedication, and patriotism for our country. We know through experience that different ideas, perspectives, and backgrounds create a stronger and more creative organization that delivers better results for the veterans and families we strive to assist. For more information, visit davma.org.
Beneficiary planning and asset protection go hand in hand, but leaving everything to your kids can be problematic. Call Cushing & Dolan at 866-848-5699 and get their new guide called How to Leave Assets to Your Beneficiaries. Don't leave your future or your children's future to chance. Call 866-848-5699 or request it online from our website, LegalExchangeShow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated. Breaking business and financial news first throughout the day, only here on the Financial Exchange Radio Network.
Well, the hope and dream of Federal Reserve rate cuts this year seems to be slipping away right in front of us. Taking a look at the Chicago Mercantile Exchange CME futures, which, again, this tool isn't any better than any other tool at forecasting where rates are going to go. It's just where people seem to be placing their bets at the moment. As of this morning, after the inflation reading that we received today, the likelihood that rates are exactly where they are today by that December meeting is now close to 1 in 5, 18.5%. The likelihood that rates are at least 4.75 to 5%, meaning 2 cuts or less by year end, that probability is now sitting at 68 plus 20, nearly 80% probability. About 3/4 likelihood that rates get cut no more than 0.5% by year end. The same probability. So the likelihood as of 1 month ago, just a month ago, right? We're not going back to the beginning of this year, just 1 month ago, that rates were as high as they are right now by year end was less than 1%. So if you're trying to understand the kind of turn in thinking about where rates go, where inflation is going, and just the sentiment shift on rates in general, this to me defines that pretty well, right? You went from almost no shot that rates don't get cut this year to very strong likelihood that they don't move one bit. And that's correlated pretty well, by the way, with the recent rise in longer-term rates as well. So if we take a look at the 10-year Treasury yield 1 month ago, we were sitting at about 4.25. Today, we're sitting at about 4.6. So expectations around inflation and where rates are going seem to have shifted quite a bit. And my own personal view on all this is, in terms of rate cuts, which, again, if you try and make a living on forecasting what the Federal Reserve is going to do, you'll probably have about as much success as forecasting what OPEC is going to do. It's challenging. But my personal view would be, if you don't have justification to cut rates by the, I'm going to call it July 31st meeting, then it's going to be tremendously difficult to do so in either the September or November meetings, because you will be doing so right before an election. So my personal view would be, if the data does not markedly improve on inflation in the next, let's see, July 31st. So we will have April, May, and June data by that July 31st meeting, unless those don't basically put you towards 2%, unless those data put you towards 2% inflation, then I don't see how you can get a rate cut at all this year.
So the Fed has two jobs: price stability, which doesn't mean no inflation.
Yep.
It just means low and stable. That's how it's been interpreted.
Natural
so
rates.
Stable that you don't even notice it. That's
Right.
the way Greenspan used to think about it. He didn't have a target, but that's the way he used to think about it. I think that's a good operational definition of price stability. And, of course, maximum potential, either employment or growth, however you want to think about it. So looking at where we are today, just being sort of factual, using that definition, applying it to the economy today. Do we have price stability? No, not really. Inflation's elevated. It's what we've been talking about for the past hour.
Bare minimum, if you look at it, you're running about twice the rate that the Federal Reserve wants.
So by that criteria there, Powell's failing. And I'll just say Powell, I mean collectively the policymakers. By the potential output at potential criteria, we're probably running a little hot, notwithstanding yesterday's GDP report. So by those two criteria, the Fed is not doing its job right now. Rates either haven't been high enough for long enough, or, God forbid, for the stock market, because they seem to be perpetually pricing in best case. Sorry for popping my piece there, Tucker.
I like that alliteration. That was good. They seem to be pricing in cuts. Yeah.
Thank you for helping me get back on my train of thought. So stocks might be disappointed if growth doesn't slow enough to subdue inflation. Just look at the facts as they are. The criteria for Fed success are very simple. We don't need political involvement to help them achieve their goals. You can replace Powell if he's not getting it done. I don't even object to replacing him early. He's not gotten the job done. We've got a several-year track record. He's been failing for the past 4. I certainly wouldn't object to him getting replaced or stepping aside. They're not going to happen, of course. But, Mike, by those fairly objective criteria, and there's wiggle room in those definitions, what is a stable price? What is potential growth? By no reasonable definition is the Fed doing its job right.
Beneficiary planning and asset protection go hand in hand, and Cushing and Dolan, the experts in elder law and taxation, can help make your planning process smooth and easy. Simply saying you're leaving everything to your kids isn't as simple as it sounds, especially if they have problems of their own. If you're retired or nearing retirement, it's time to consider the best way to keep your assets in your family while avoiding significant financial consequences down the road. Call Cushing and Dolan right now at 866-848-5699 and get their new guide called How to Leave Assets to Your Beneficiaries. You'll learn which paths are the safest when it comes to protecting yourself and your children while avoiding unnecessary risk that can cost you dearly in the long run. That number again is 866-848-5699, or you can request it from their website, legalexchangeshow.com.
The proceeding was paid for, and the views expressed are solely those of Cushing and Dolan. Cushing and Dolan and/or Armstrong Advisory may contact you offering legal or investment services. Cushing and Armstrong do not endorse each other and are not affiliated.
The trading activity at large investment firms such as Charles Schwab, Morgan Stanley, and Robinhood are reaching levels that were last seen in early 2022. The Wall Street Journal interpreting that as the thrill factor being back for retail investors. I guess that's as good a theory as any. I don't really have any other theory as to why retail investors would be placing so many trades in the first quarter, but the average daily number of client trades handled by Charles Schwab, for example, rose and is up 15% from the last quarter of 2023 and is also the highest rate that you've seen since the second quarter of 2022. Morgan Stanley owns E-Trade, which is another big self-directed investor platform. 841,000 trades a day in the first quarter, also the highest that you've seen since the second quarter of 2022. And if that is the interpretation that, hey, the thrill factor's back for traders and look how well markets have done over the last 6 months, I will not make you go back 30 years. I'm just going to make you put yourself back in the place that you were in 2021, when the thrill factor was definitely there for investors. Every week you had a new SPAC, you had a new shorted stock that was going to the moon. I will just ask people to remember what those same things did in 2022 when all of that reversed course. I don't know that we're getting to that level of thrill and speculation that we saw back then, but even the gurus of that year, right? Cathie Wood and everybody who was so spectacular at investing, even those self-proclaimed and other proclaimed gurus have not done so well in the years that have followed. And so my main warning and just interpretation of all of this is do not allow the thrill factor and the excitement about markets at any point in time to change your long-term view on what you are trying to accomplish. Don't play somebody else's game when it comes to the stock market.
Big shocker, Mike. I blame the Fed for keeping policy too
loose
loose for too long.
Of course you do.
It's engendered this speculative frenzy. It's ebbed and flowed over the past 4 years, but volume is several times what it was prior to COVID.
Let's take a quick break. When we come back, earnings from Microsoft and Google. We'll be diving in next.
Hi, this is Chuck and Mike from the Armstrong Advisory Group, and our guide this month is titled Preparing for an Upcoming Retirement. Mike, what are some of the things that can derail a retirement that otherwise would be going fine?
I mean, there's all sorts of items. Certainly, a pension going bust or Social Security getting reduced, people worry about. Certainly, we all worry about market volatility and the risks there or inflation. But one of the ones that I think people almost intentionally avoid is the risk of increased healthcare costs. I think we're familiar with Medicare costs and things along those lines. But the portion of Americans who will face some sort of heavy end-of-life care and the costs associated with it, it's a big chunk of Americans, and gosh, it's such a taboo issue that we hate talking about and being transparent about. And so you really have to tackle that one and be straightforward with the potential risk.
It seems to me that just doing some stress testing with some actual numbers can make a big difference in determining whether or not that can cause a problem for you.
Yeah, most certainly. But the costs of things like nursing homes or assisted living facilities are so frightening to people and almost unfathomable in terms of total cost that we just choose to stick our head in the sand sometimes. And that's not necessarily the wrong approach to things like market volatility. But when it comes to planning out your future financial success, putting your head in the sand is a losing strategy.
Our guide this month is titled Preparing for an Upcoming Retirement, and there are two different ways that you can request it. The first is by calling 800-393-4001. The second is by visiting ArmstrongAdvisory.com. That phone number again is 800-393-4001, or you can visit ArmstrongAdvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
Are you retired like me and you just found out you owe the IRS a ton of money? Well, what would your life be like if they took your retirement savings away from you? They can do it and your property. If you owe the IRS back taxes or or you haven't filed in a while, the Tax Relief Line is here to help you. They can stop the IRS from taking your retirement savings. If you qualify, you could have your tax bill reduced to zero. That's right. If you're retired and you owe the IRS a lot in back taxes, you could have your entire tax bill reduced to zero due. The IRS has now hired thousands of new employees, so they're ready to come after you. Don't let them take your retirement savings or property. Make this free call now.
800-251-2153. 800-251-2153. 800-251-2153. That's 800-251-2153.
This is the Money Matters Radio Network. WBNW 1120 AM and W275CM FM. Concord, Boston. The Money Matters Radio Network.
Do you use the expensive blue or yellow pills to charge your sex life? Are you thinking about it? What if we can promise you the same results for less than $3 a pill? If you're paying $20 a pill for the other pills, you're getting taken to the cleaners. Our pills deliver the exact same results for less than $3. You'll save more than $16 a pill for the same results. And right now, radio callers will get 44 blue or yellow pills for $120 with free discreet shipping. You can save more than $700 off pharmacy prices. Charge your sex life now and save a ton of money. Call now and get your 44 pills and save over $700 and qualify for free shipping. Stop overpaying and call right now.
Paid for by Steel Man Pills. 800-475-8547. 800-475-8547. 800-475-8547. That's 800-475-8547.
If you served in the Marine Corps, by now you know about the contaminated water problem at Camp Lejeune. If you were stationed or worked at Camp Lejeune from 1953 to 1987, you probably have a lot of questions. We have some answers. You could be entitled to compensation. Billions of dollars are being allocated to pay for damages to anyone stationed at Camp Lejeune during that time. Unfortunately, it appears that officials may have known the contaminated water problem existed and did little to protect their men. The Semper Fi code was not honored. If you or someone in your family has developed a serious illness, including various forms of cancer, call this Camp Lejeune legal support line right now. You can't turn back the clock and change what happened, but you can certainly call right now and learn your rights as a Marine. Here's the number.
800-477-1736. 800-477-1736. That's 800-477-1736. Paid for by Legal Alert Line.
Leaving assets to your beneficiaries is a critical piece of any estate plan. Cushing & Dolan has written a new guide that may help you avoid unnecessary mistakes that can cost you dearly in the long run and ensure that your assets are protected for generations to come. An example? The federal estate tax exemption has increased by nearly $1 million from 2023. That could lead to a larger inheritance for your family members. There are several strategies in this new guide that will help you learn how to make the right decisions about your distributions at the right time. Cushing & Dolan have been helping New England families for more than 30 years. Let them help you too. Call 866-848-5699 and get their brand new guide called How to Leave Assets to Your Beneficiaries. That number again is 866-848-5699. Or you can request the guide online by visiting LegalExchangeShow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
Building a solid financial strategy is a core element to enjoying your retirement years. That's why you need advice that you can count on. At the Armstrong Advisory Group, we understand the challenges of positioning your assets to help you maintain your wealth over time. Our goal is to offer advice that is both suitable and in your best interest. When you hire one of us, you hire all of us so you can be comfortable knowing that every advisor in our firm is dedicated to helping you create a realistic plan for your later years. Visit us today at armstrongadvisory.com and sign up for a free, no-obligation planning session. Click the Get Started button at the top right corner of the homepage, and you can select the day and time that works best for you. Go to armstrongadvisory.com and let us help you secure your financial future. That's armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. The U.S. Virgin Islands is St. Croix, St. Thomas, and St. John. Visit one or all three and enjoy the vacation of a lifetime. Each island is special in its own unique way. So whether you want the heritage of St. Croix, the pristine beaches of St. Thomas, or the calm and relaxation of St. John, the U.S. Virgin Islands is one of the top vacation spots to visit in the Caribbean. You can expect perfect temperatures, a wide variety of water sports, world-class cuisine, and a vibrant nightlife. From the moment you arrive, you'll fall naturally in rhythm with the heartbeat of the islands. There's no money to exchange, and travel from New England could not be easier. Make your plans now by going to visitusvi.com. Learn about all three islands and plan the ideal vacation for you and your family. America's Caribbean paradise is waiting for you. So head to visitusvi.com for more information and to reserve your trip today. That's visitusvi.com. The Financial Exchange is produced by Money Matters Radio and is hosted by employees of the Armstrong Advisory Group, a registered investment advisor that provides investment advisory services. All opinions expressed are solely those of the hosts, do not reflect the opinions of Armstrong Advisory or anyone else, and do not guarantee profit. Investments can lose money. This program does not offer any specific financial or investment advice. Please consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong and Money Matters Radio do not compensate each other for referrals and are not affiliated. This is the Financial Exchange with Mike Armstrong and Marc Fandetti. Your exclusive look at business and financial news affecting your day, your city, your world. Stay informed and up to date about economic and market trends, plus breaking business news every day. The Financial Exchange is a proud partner of the Disabled American Veterans Department of Massachusetts. Help us support our great American heroes by visiting dav5k.boston and making a donation today. The DAV 5K Boston is presented by Veterans Development Corporation. This is the Financial Exchange with Mike Armstrong and Marc Fandetti.
Welcome back to the Financial Exchange. We're jumping right into it here with markets soaring back from yesterday's losses. NASDAQ up now over 2.2%, 344 points. We'll be diving into earnings from Google and Microsoft. S&P up 59 points, 1.16%, and the Dow at the moment up 139 points, about 1/3%. So very tech-heavy drive this morning. Before we get into earnings, though, we did get a release on inflation this morning. This from the Bureau of Economic Analysis for the month of March. What we found, year-over-year inflation, which is the number that you're going to hear quoted by most media sources, 2.7% year-over-year inflation, 2.8% if you strip out food and energy. More importantly, in our opinion, the month-over-month numbers, which for the last 3 months have been elevated. Regular PCE inflation, 0.3% month-over-month on both core and with food and energy in there. That follows readings on core for the last 3 months. So January came in at 0.5%, February 0.3%, and March now 0.3%. What this indicates to me personally, and I won't put words in Mark's mouth, is that we saw a brief period of slower inflation. If you're taking a look back in the fourth quarter of last year, that seems to have been a blip on the radar, and we are now experiencing a 3-month period now of higher than anticipated inflation. And there's a number of different ways to cut this data, but if you annualize just the month of March, obviously you get to a 3.6% rate. Just multiply 0.3 times 12. If you take a look at the average of the last 3 months, you're getting to a 4% rate of inflation on the PCE index, neither of which are anywhere near the Federal Reserve's target of 2%, meaning probably what investors are already digesting, that rates need to be higher for longer and might not get a cut this year.
And I think you summed it up well, the current state. And yet equity markets are up and bond yields are down. So were markets expecting, I know that the 0.3% month over month in the so-called PCE index, or personal consumption expenditures deflator, which is just a different way to calculate inflation. It's the Fed's preferred measure for various reasons, Mike, as you mentioned. That was in line, I guess, with expectations as published in various media outlets.
Yep.
Is that why markets are shrugging it off? Because to your point, inflation remains much higher than the
I'll
Fed's
go back
goal.
to your point, Mark. Never try and interpret what the market's doing on a single day.
My question was a little bit rhetorical. I thought
the other piece that I'll say is we get PCE towards the end of the month. We already got CPI for the month of March. And while I wouldn't know how to do it, there are people out there that can probably take a look at CPI data and predict pretty easily what PCE is going to look like. And so it's fairly normal for us to get a reading on PCE that is well predicted, well understood where it's already going to be by the time it comes out.
I don't know about that. Are the forecast
Disagree?
errors? I'm not. It's an empirical, as researchers like to say, question. I can look at the relationship between the two over time. Are the forecast errors, as a researcher would say, lower when you plug CPI into a PCE forecasting model as opposed to just using the past value of PCE? I can answer that. I just can't do it right now. But to your point, nobody's surprised because CPI came in at 0.4 month over month a couple weeks ago.
Yep.
PCE is now at about the same
overall
clip.
pace.
Yeah.
So this week we've heard earnings from Meta, Tesla, Google, Microsoft. I actually think I put it well earlier on a call with somebody. We heard earnings from 3 major tech companies and also Tesla, is how I would put it, because when you're under $500 million in market cap, I'm not going to consider you a major tech company anymore, nor are you a tech company in the first part. You're an auto manufacturer, but neither here nor there. So let's dive into Alphabet and Microsoft in particular. Before I get there, I will just make a point that Meta was down. Did they finish down double digits or just high single digits yesterday? 8.5% or something like that yesterday on their finish. Zuckerberg on his earnings call basically reiterated to investors that they are going to be pouring a lot of money into artificial intelligence research, and that could be a multi-year process, and then went on to say that, historically when they have done endeavors like this, their stock price has been volatile, and it took a big hit. Microsoft and Google, I don't know if they took lessons from what Mark Zuckerberg had to say, but seemed to, while also admitting that they are pouring a lot of money into artificial intelligence, de-emphasize that part of their earnings call a fair bit compared to Zuckerberg's approach, which was just put all the cards on the table.
Yeah, I don't know how to interpret someone's expectation for the degree to which AI, artificial intelligence spending will pay off. There's a huge gap between the people that do that, an unusually large gap between the experts and the rest of us. Mm-hmm. No stock analyst, no matter what kind of word salad they throw together about AI and how much they sound like they know what they're talking about, they're just blustering their way through the subject. The only people that really get it are the coders that create it and implement it, and you have to take their word for it.
So in early market trading so far, Microsoft stock up 2.88% at the moment. Alphabet stock up 9.4% at the moment. Here's my summary of what we heard from these two companies. So one, Meta, Microsoft, Google, all reporting very strong earnings, both for the previous quarter as well as their general forecast for where sales are going to go for the year. Those did not disappoint. What was a disappointment seemingly on Meta's side was the amount of investment going in, and I would call it a lack of clarity on how that is going to be monetized for the future. Doesn't mean it won't be, just not terribly clear how it's going to be. Microsoft was able to point to a few data points that I think made it somewhat clear that they believe artificial intelligence is having an impact on their business already. The main one that I can point to was that Microsoft claiming, so one, their Microsoft Azure, which is their cloud services, that rose by 31% during the quarter. Microsoft leaders said that 7% of that 31 came from AI services. And so, unlike other companies with Microsoft, it's fairly easy for even a kind of AI dummy like myself to look at their products and say, okay, I can understand how it would be useful if I could feed an AI bot a bunch of data that I'm trying to put into an attractive PowerPoint presentation and say, hey, go build this for me with using the theme from this website. I can see how that would be very, very useful.
Is that actually happening?
Poorly. But yes, that's what they want to do.
I know it's what they want to do, but
so
is that available to, say, ordinary
So there
schmucks
are
like me?
some people that are using Copilot, which was their system that was used, that was released earlier this year. So far, the Copilot seems really good at transcribing notes for Microsoft Teams. So if you're in a video conference or in a meeting and you want the AI bot to basically take notes on what was discussed in the meeting, really good at that. It's also capable of creating spreadsheets, writing emails, putting together PowerPoint presentations, and according to some customers, not so good at that stuff yet. So, but I mean, I have no evidence that they're ever going to be able to get there. But unlike with Google and Facebook, I don't even really understand how AI will improve their business substantially. So for Microsoft, at least, I can say, yeah, if they can do this, and I wouldn't be surprised if they get to a point where an AI bot can create a PowerPoint presentation that looks reasonably attractive and useful to me, then, hey, maybe I don't need as many investment bankers in New York creating that stuff for me in the future.
Yeah, it is infuriating to have to spend a lot of time sizing stuff in a PowerPoint presentation, getting it to look right. That's low value add.
Yep.
Any monkey could do it, forgive me. And to have to pay an employee to do that, a college-educated person, seems like a total waste. And yet we still struggle with that. The making spreadsheet work easier, I guess it depends on the task. This stuff doesn't have the judgment to do good data analytics, and probably given the creativity element involved in good data analysis, probably I'll go out on a limb and say it won't be comparable to what human beings can do for a very long time.
Yeah, I wouldn't say that it'd be capable of doing that, but like for instance, if it could write a macro for me on a spreadsheet that would allow me to analyze data sets over time, and again, I'm not looking for to do the analysis, but just, hey, write me the macro to do this repeatable process over and over.
But that's a coder. I mean, we could write one line of code in Python or R, my preferred platform, and have that set up for life too. So that's not hard.
We could, but you need the person today with that intelligence and knowledge to do it.
You do, and you also have to know how to frame the question.
Right.
And I don't know that AI, well, not without the domain expertise, can get us there anytime soon. I don't know. I'm skeptical. I hear AI, and I think somebody's trying to sell me something.
I hear you.
That's just my nature.
On the Alphabet side of things, I likewise remain pretty skeptical about how AI is going to transform their business. In fact, I kind of view it as a big threat, right? If I want the answer to a question right now, I don't know what you do, Mark, but I go to Google and I search it, and the first 5 results are sponsored ads from Google. The next 5 are kind of selected based on this algorithm that I'm not sure how it works. The dream of AI is I can just ask a chatbot the answer to a question, and it will give me the answer with some sort of some cited sources, and I don't know how you advertise on top of that. So I do get a little bit concerned about Google's core business, but what the company basically came out and said is, hey, we have been incredibly profitable. We are going to be paying our first ever dividend. Revenue grew 15% in the latest quarter. And while they too admitted that they're going to be investing a lot in artificial intelligence, like I said, I think the main difference between them and Meta was they really de-emphasized it in this most recent quarter in terms of how much they're going to spend, how long it's going to take, and where it's going to go. Might be the exact same result as Meta, but for the time being, de-emphasizing a little bit, at least in the earnings call. Let's take a quick break. When we come back, we're going to have some trivia for you next on the Financial Exchange.
The latest news on inflation, the Fed, the economy, and how the markets are reacting every morning, right here on the Financial Exchange Radio Network.
How does your DAV membership benefit you? As a DAV member, in addition to DAV programs and services, members are entitled to a member benefits package, which gives you access to a variety of important programs, products, and services. Also included with your membership is a free subscription to DAV Magazine. For more information, visit davma.org. That's davma.org.
Beneficiary planning and asset protection go hand in hand, but leaving everything to your kids can be problematic. Call Cushing & Dolan at 866-848-5699 and get their new guide called How to Leave Assets to Your Beneficiaries. Don't leave your future or your children's future to chance. Call 866-848-5699 or request it online from our website, LegalExchangeShow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated. The U.S. Virgin Islands is St. Croix, St. Thomas, and St. John. Visit one or all 3 and enjoy the vacation of a lifetime. Each island is special in its own unique way. So whether you want the heritage of St. Croix, the pristine beaches of St. Thomas, or the calm and relaxation of St. John, the U.S. Virgin Islands is one of the top vacation spots to visit in the Caribbean. You can expect perfect temperatures, a wide variety of water sports, world-class cuisine, and a vibrant nightlife. From the moment you arrive, you'll fall naturally in rhythm with the heartbeat of the islands. There's no money to exchange, and travel from New England could not be easier. Make your plans now by going to visitusvi.com. Learn about all 3 islands and plan the ideal vacation for you and your family. America's Caribbean paradise is waiting for you. So head to visitusvi.com for more information and to reserve your trip today. That's visitusvi.com.
This is Tucker Silva of the Financial Exchange Show, and I'm joined today by estate planning attorney Todd Lutzke from the law firm of Cushing & Dolan with your Financial Exchange Quick Tip of the Day. And today we're talking about your brand new guide, Todd, how to leave assets to your beneficiaries. Todd, why can't you just add your kids to your accounts or to your house deed?
Well, you can. It's just not a good idea. So people who do that understand with an account, right, you can put a joint name on the account. Now, that doesn't actually complete the gift because you actually have to take the money out and then the gift is complete. But when you set it up, yeah, the asset would avoid probate. But if something happens to the child, it's going to be, available. Half the asset would be subject to the children's creditor. So you don't want that. And secondly, if you only put one kid on the deed, you've likely disinherited the other kids. So it's not really good planning overall. Whereas if you put the house in the kid's name, now you've actually made a completed gift of half the house and would need to file a gift tax return, number one. Number two, of course, it's exposed to the child's creditors and, yes, divorces. You could find yourself at some point owning half your house with an ex-in-law. Not sure that's a good way to plan. So please, put together trusts. Don't just throw names on deeds or on bank accounts because, as I always like to say, nothing good comes from giving assets away while you're living.
The estate planning experts at Cushing & Dolan have been helping families like yours for more than 30 years, and they've written a brand new guide called How to Leave Assets to Your Beneficiaries. To get your free copy of this comprehensive guide that will help you determine the best way to leave assets to your family, simply call 866-848-5699. That's 866-848-5699, or you can request it from their website, legalexchangeshow.com.
The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing and Armstrong do not endorse each other and are not affiliated. The Financial Exchange is now available on your Alexa smart speaker. Ask to play the Financial Exchange and catch up on anything you might have missed. This is the Financial Exchange Radio Network.
Trivia is brought to you by Applebee's. Choose from a variety of half-price late-night appetizers after 9 p.m., including half-price boneless buffalo wings, half-price spinach and artichoke dip, and half-price warm pretzels dipped in beer cheese. Gather with friends any day of the week at Applebee's and say hello to half-price appetizers served late night because half off is just more fun. Now, that's eating good in the neighborhood. Void where prohibited. Dine in only. Well, on this date, back in 2005... Bruce Springsteen released his 13th studio album, Devils and Dust. The album was a success for the boss as it became his 5th #1 album. Springsteen's most successful album of all time is Born in the USA, which sold over 30 million copies. Trivia question today, what year was Born in the USA released? Once again, what year was Born in the USA released? Be the 9th person today to text us at 617-362-1385 with the correct answer. And win a Financial Exchange Show t-shirt and be registered to win a $100 gift card to Applebee's. Be sure to include the keyword Applebee's in your text, and we'll give away that Applebee's gift card in the next segment. 617-362-1385, and the 9th correct response will be our winner. See complete contest rules at financialexchangeshow.com.
Music's incredible, isn't it? Like, everybody with certain songs, when it plays, your mind just goes to one instant in your life. And for me, when Born in the USA is played, I go back to as like a 10-year-old playing in this hockey tournament in Magog, Quebec, where I don't know if they just had nothing going on in Magog, Quebec, but like the whole town would show up to these kids' hockey games, and every time our Boston-based team would take the ice, they would play Bruce Springsteen's Born in the USA because we're the only American hockey team there. So yeah, it's funny how music does that to you. That was hadn't really thought about that moment for a long period of time. Anyway, want to talk about China?
Please.
Okay, let's not talk about my illustrious hockey career anymore. China, in a further evidence of an economy that is not doing so well, has come up with their own version of cash for clunkers. They're going to be paying consumers up to nearly $1,400, which, again, for compared to U.S. cars, that might not be a whole lot of money, but $1,400 to the Chinese consumer in order to replace their old cars with newer versions of them. Why? Probably not because China is immensely concerned about their global impact on emissions, and much more to do with the fact that, oh crap, we have all these cars, the rest of the world doesn't want to buy them. We'd better find a way to spur some growth in our economy by getting our own demand up off the floor here. So that's how I interpret all of this is, again, like we did in 2009, I'm sure that there are plenty that were talking about the environmental benefits of it as well. But the Cash for Clunkers program was basically a way to bail out the U.S. automakers. And this seems to be the same thing over in China.
Boy, a lot of bad ideas coming out today. Fed independence being questioned, cash for clunk. I don't care what the Chinese do with how in debt they become. Pursue all the stupid economic ideas that we've tried and arguably fruitlessly, you'd like if you're China from my point of view. But yeah, Mike, I think you nailed it. It stimulates, it kills a few birds. I don't know if that's a Confucian proverb or not, but it kills a few birds with one stone. I don't think it is.
I think what I find particularly interesting about this is we've talked really since the real estate crisis in China really took hold there and the economy was clearly in recession about how the Chinese government seemed very resistant to any sort of direct consumer stimulus like we did during COVID, which, again, I would argue a lot of that was a mistake. But they were very, very hesitant to, say, send people checks in the mail like was done in the United States for either the Paycheck Protection Program or all sorts of stimulus programs that were passed over the last few years. This is the first one I've seen in China that is as close as it gets to a direct stimulus program to the Chinese consumer.
Yeah, so, it's very harebrained Western. In
they're coming around,
and I agree.
At the same time, Antony Blinken's meeting with President Xi in China, allegedly pressuring China to end their support for Russia. I can't really imagine how or why he's going to have any more success than any other leader has had recently. Germany just had leadership in China as well, doing the exact same thing, and one would think that the Europeans have a little bit more vested interest in this one and pressuring China to stop this type of behavior than the United States does. And the commentary coming out of that meeting was basically more of the same. And quite honestly, China's probably right to call our bluff on this one. If you're sitting there and not morally right or any of those things, but if you're sitting there in Chinese leadership and you're taking a look at the overall sentiment on support for Ukraine in this war right now, you're probably thinking, hey, we can wait this one out. At least that's what I would be thinking, right? Like, is American sentiment towards support for Ukraine so abundantly strong that we would be putting ourselves in danger if we're China by continuing to support Russia? I think the answer is probably not. Relationship with Europe, different story, and I'll be interested to see where that goes, but in the United States,
yeah, I don't know that we need to look. We're at war with Russia right now. It's a proxy war, but it is a war.
Yeah.
I mean, we're spending a lot of money, and the support is held up. You could say that it's softened a bit, but for nearly 3 years into this thing, or going on 3 years into this thing, or the third year of this conflict, it's held up surprisingly well, given our short attention span as Americans. So I think you're probably right. China just bides its time, doesn't do anything too overtly aggressive.
Not going to give them direct weapons.
I don't know. It's not my area.
Supplies.
What the heck do I know?
Yeah. Again, if I'm China, I'm calling the bluff on this one and waiting it out would be my guess. And I don't really expect that behavior to change.
What leverage do we have other than
trade?
Yeah, but both presidential candidates, I mean, Trump wants to, put a 10 or 50%?
Right.
I don't even know. He quotes a different number every time he speaks about it, but it's always higher. So higher tariffs will come from Trump, presumably, unless he's just using that as a negotiating technique, because he's a masterful negotiator, as we all know.
Let's take it. Yeah.
What leverage do we have?
I hear you. Let's take a quick break. When we come
We are the Debt Destroyer Network. Any debt you have, credit card, tax, student loan debt, call now for free information that helps you destroy your debt. It's great advice. Plus, when you make this free call now, we have debt destroyer experts ready to help. They can show you how to destroy your debt and get your life back on track. Debt problems don't have to be overwhelming. You can live stress-free and debt-free. Credit cards, medical bills, IRS tax problems, even student loan debt. Learn about free programs offered by the credit card companies, hospitals, and even the government that can help slash your debt. Call the Debt Destroyer now for free information. Call now. 800-430-8804. 800-430-8804. 800-430-8804. Again, that's 800-430-8804.
To be engaged, you must feel included and valued. The DAV Department of Massachusetts nurtures a culture where inclusiveness is a reflex, not an initiative, where there's a deep sense of pride, passion, and belonging that is unified in our shared commitment, dedication, and patriotism for our country. We know through experience that different ideas, perspectives, and backgrounds create a stronger and more creative organization that delivers better results for the veterans and families we strive to assist. For more information, visit davma.org.
Beneficiary planning and asset protection go hand in hand, but leaving everything to your kids can be problematic. Call Cushing & Dolan at 866-848-5699 and get their new guide called How to Leave Assets to Your Beneficiaries. Don't leave your future or your children's future to chance. Call 866-848-5699 or request it online from our website, legalexchangeshow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated. The U.S. Virgin Islands is St. Croix, St. Thomas, and St. John. Visit one or all three and enjoy the vacation of a lifetime. Each island is special in its own unique way. So whether you want the heritage of St. Croix, the pristine beaches of St. Thomas, or the calm and relaxation of St. John, the U.S. Virgin Islands is one of the top vacation spots to visit in the Caribbean. You can expect perfect temperatures, a wide variety of water sports, world-class cuisine, and a vibrant nightlife. From the moment you arrive, you'll fall naturally in rhythm with the heartbeat of the islands. There's no money to exchange, and travel from New England could not be easier. Make your plans now by going to visitusvi.com. Learn about all three islands and plan the ideal vacation for you and your family. America's Caribbean paradise is waiting for you. So head to visitusvi.com for more information and to reserve your trip today. That's visitusvi.com.
Hi, this is Chuck and Mike from the Armstrong Advisory Group, and our guide this month is titled Preparing for an Upcoming Retirement. Mike, what kinds of things do people need to look at to know whether or not they can undertake a successful retirement?
Yeah, I mean, first steps first, we talk about your income sources in retirement versus your expenses. And usually the easiest thing today is to look at what are my income sources now, how will they change, and what are my expenses now, and how are they likely to change. On the expense side, oftentimes it's not that big of a change, but I think that's the first starting point before getting into more complicated things such as my investment portfolio, my health insurance situation, or Social Security strategies.
Mike, a lot of times people are concerned about whether they have enough to live all the way through retirement, and so they might delay their retirement significantly. But it's also worth pointing out that sometimes the biggest risk is not retiring early enough, and you might miss out on some retirement years that way.
Yeah, I mean, look, we all do get worried about longevity, and there are plenty of warnings out there in the media about how Social Security or these other things might not keep pace. But man, it sure is devastating to see the opposite one where you work your whole career, work your tail off, save all this money, and it can impact your health. It can impact all sorts of things. And to not get to enjoy that full retirement because you choose to work longer than you might have needed to is so much more frustrating.
Our guide this month is titled Preparing for an Upcoming Retirement, and there are two ways you can request it. The first is by calling 800-393-4001. The second is by going to armstrongadvisory.com. That phone number again is 800-393-4001, or you can visit armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. The Financial Exchange streams live on YouTube. Like our page and stay up to date on breaking business news all morning long. This is the Financial Exchange Radio Network.
Trivia question today was, what year was Bruce Springsteen Born in the USA released? That would be 1984, June 4th, 1984. The album would go on to sell over 30 million copies and be certified multi-diamond. We have two winners to announce today. Winner of the Financial Exchange Show t-shirt was Jane from Norwell, Mass. And the weekly winner of the $100 gift card to Applebee's was Kevin from Yarmouth, Mass. So congrats to both winners there. And trivia is brought to you by Applebee's. Choose from a variety of half-priced late-night appetizers after 9 p.m. because half off is just more fun. Now, that's eating good in the neighborhood. Void where prohibited. Dine in only.
There's a piece in the Financial Times today from Sumaya Keynes, who I had to look up, is actually the great-great-niece of John Maynard Keynes, which not terribly relevant in terms of her own work, but I just found interesting that, somebody writing about economics.
He had no kids, so I didn't know he had any living
great-great-niece
relatives. No, I never thought about his lineage.
Right. Whole theory of economics named after
the
Keynes.
guy's Keynes is the father of all this demand management, for good or for bad, stuff that governments do. He came out of the Depression. We had 25% unemployment. We had food sitting in fields and people starving.
Yep.
We had factories with beautiful new machinery. This was after the big explosion in the industrial era, and nobody working. This was a real paradox. And he did revolutionize the way we think about getting people to work.
But again, that has nothing to do with Sumaya.
Well, you mentioned her name, Keynes' name, and people have heard John Maynard Keynes, and they've heard Keynesian.
Yes.
Because Nixon famously said, we're all Keynesians now, which was license for him to just spend a lot of money. But that came out, well, it was. So a lot of mischief, but a lot of, it was the birth of the modern economics profession. And it's why we have all these conversations about policy and its influence on markets. Probably would have happened had he not lived, but he revolutionized and continues to influence everybody, whether or not you know it.
So in either case, his great-great-niece
but anyway,
has some critiques for economists out there, and her general point to me seems to be that you need to dumb it down, economists. You put together all this work, which is really useful and really insightful, and then you don't actually propose what the policy should be to deal with all these things, and that is her conclusion, is that dumb it down, don't make it into a 60-page novel, and come to a conclusion rather than just putting it out there.
There's not always a policy prescription, and evidence is constantly reinterpreted. The same evidence can be reinterpreted using different methods, and different conclusions can be arrived at. I could speak a little bit for people. My little area is applied financial economics. So you do some research, you, God willing, get it published, and someone takes your data, uses different methodology, and comes to totally, I haven't had this happen, it'll be embarrassing, it will at some point, comes to totally different conclusions, and you say, oh, damn, I wish I had done it that way. So there's a certain amount of humility that a good researcher exercises.
Yeah.
Economists don't really try to prescribe necessarily. Some do. They're very vocal, almost to the point of being obnoxious. Most are just trying to do good research and get at answers to things. So I'm not sure, and she would know, if nothing else, because of her lineage. She knows what the job of a researcher is. It's not always to tell people what to do.
Yeah, I'm with you. And she does acknowledge that some of the purpose of any sort of research, whether it's economic or any other, should just be for the sake of moving the profession forward and moving the theory forward rather than actually coming up with policy. But economics in particular is particularly policy-driven.
And we say economics, but most of it is just very boring workaday, especially like these labor economists. They asked a change in this variable, like the minimum wage or some other aspect of labor employer relations. Did it noticeably change labor market dynamics in this specific it's workaday, it's boring, it's not anything anybody would be interested in. Most of what economists do just wouldn't be of much interest to the general public, I don't think.
Tucker, Mark, are you suffering from money illusion?
I don't know. I don't know what that is.
It's a new term for me. I had not known that it was something was being
Never heard
used.
money illusion?
Money illusion.
Like money I don't have that I want?
That's what money illusion.
Yes. Then yes.
Or thinking that my credit card spending limit is real money is money illusion. No, define for me money illusion, Mark.
It's that people are fooled by inflation, basically. They confuse nominal, that is non-inflation adjusted, and real variables. So if the price of everything, a negative example is if the price of everything goes up, I'm automatically worse off. Well, if real wages are flat to positive, that's not necessarily the case. Similarly, if your wage goes up, it doesn't necessarily mean you're better off.
Yeah. So there's all sorts of money illusion out there. A very simple example is that $1 in March 2021 is worth less than 85 cents today. So that's the first fundamental one that I think people are starting to get a grasp on based on inflation, but that's plain English. If you had $1 in 2021, what it can buy you is about 85 cents of stuff today. On average,
how's
according
that illusion,
to the government's
is that
own
is that the example they use?
Well, they're pointing out that people don't really understand that $1 is worth a lot less than it used to be.
Oh, I think people understand.
Yeah.
You kidding? Have you been talking to people?
Right. Like they seem to be getting that pretty evidently. Yeah.
I think we get it. But anyway, it's one way to. It's not necessarily the easiest concept to explain.
Likewise,
inflation can fool people. That's how I've always thought about it. I think Keynes may have used the phrase. Actually, we talked about John Maynard Keynes a couple of minutes ago.
Yeah. And this carries into all sorts of areas. I don't know what to make of it because I genuinely, other than probably
Irving
a
Fisher,
few,
contemporary.
Okay.
Sorry.
Other than a few real areas, do you think that money illusion really exists? Maybe the only way that it exists now is that people think their dollar is worth even less than it is because they are so dramatically impacted by inflation that they think it's basically worthless. I'm not sure, where else the money illusion seems to be showing up.
That's almost like reverse money illusion. Like normally money illusion means, oh my God, my stocks are up. Yeah, but prices doubled too.
Yeah.
Like you fell for money illusion. You can't actually buy more in terms of goods and services with those assets because were inflated by inflation. That is the classic way to present it. But yeah, you're describing sort of money illusion in reverse.
Yeah.
Yeah, sure.
Another version, or just maybe my own different version of money illusion that I always like to bring up is people's illusion when it comes to the lottery recently. So we've talked about this, Mark, a little bit, and it's not directly related to inflation. It's more related to interest rates.
Oh, yeah.
But for everybody out there that seems to be noticing that the Mega Millions and Powerball keep hitting $1 billion much more frequently and wondering, wow, did they change the payouts or something? Or are way more people playing the lottery to drive this up? The answer is no. The stated number that they put on that lottery winning ticket, the little boards that hang in the gas station with the number that changes every day, has nothing to do with the lump sum payout. It has everything to do with the annuity option that you can take on your winnings from a lottery, which are all tied to interest rates. And so again,
interest rates go up, the lump sum goes down because of the inverse relationship. Or to help me.
Actually, with the lottery, the lump sum is always constant based on sales. And the annuity goes up based on interest rates.
Yeah, okay.
Same thing, right? Yep. It's one versus the other. But in the case of the lottery, that's how it works, which is slightly different, or the inverse, I guess, of how a pension works from an employer versus a lump sum. But I always find that one fascinating because I
here's
keep
a different
way.
way.
Oh my gosh, $1.3 billion again. Well, only because interest rates triple.
Because if you don't want the lump sum to go down, to keep that constant, if interest rates go up, the face value, so to speak. Mike's glossing over. Tucker just left the studio. If the face value, or whatever you want to call it, of the jackpot has to go up to keep the lump sum constant, the present value lump sum constant. Thank you, Mike.
We've got to go. We've got to stop because Paul LaMonica is joining us.
Don't you think people
I know. People like the explanation of the lottery. That's why I always try and bring it up because not everybody invests in the stock market. Not everybody knows what's going on with Google's earnings, but everybody goes to the gas station and sees those boards printed everywhere and hears the news about the Powerball. So I have to bring that up every once in a while. Let's take a quick break. When we come back, Paul LaMonica from Barron's joining us for Friday on the Financial Exchange.
Breaking business news as it happens, only here on the Financial Exchange Radio Network.
Millions of Americans are preparing for retirement, and if you're one of them, making sure you have a solid plan is the key to enjoying your later years. Hi, this is Mike Armstrong from the Armstrong Advisory Group, and I'd like to ask you two simple questions. Can you retire, and should you retire? Our new guide is called Preparing for an Upcoming Retirement, and in it, we'll discuss strategies that can help you answer these questions and others so that you can make the right decision for you and your family. There are many different elements to a sound retirement plan, including knowing how much income you'll need to live comfortably, when when to take Social Security benefits, and understanding what financial risks might be worth taking. Get your free copy of our new guide, Preparing for an Upcoming Retirement, by calling 800-393-4001, 800-393-4001, or you can request the guide at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. Beneficiary planning and asset protection go hand in hand, and Cushing & Dolan, the experts in elder law and taxation, can help make your planning process smooth and easy. Simply saying you're leaving everything to your kids isn't as simple as it sounds, especially if they have problems of their own. If you're retired or nearing retirement, it's time to consider the best way to keep your assets in your family while avoiding significant financial consequences down the road. Call Cushing & Dolan right now at 866-848-5699 and get their new guide called How to Leave Assets to Your Beneficiaries. You'll learn which paths are the safest when it comes to protecting yourself and your children while avoiding unnecessary risks that can cost you dearly in the long run. That number again is 866-848-5699, or you can request it online from our website, legalexchangeshow.com. The proceeding was paid for, and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and/or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated. The U.S. Virgin Islands is St. Croix, St. Thomas, and St. John. Visit one or all three and enjoy the vacation of a lifetime. Each island is special in its own unique way. So whether you want the heritage of St. Croix, the pristine beaches of St. Thomas, or the calm and relaxation of St. John, the U.S. Virgin Islands is one of the top vacation spots to visit in the Caribbean. You can expect perfect temperatures, a wide variety of water sports, world-class cuisine, and a vibrant nightlife. From the moment you arrive, you'll fall naturally in rhythm with the heartbeat of the islands. There's no money to exchange, and travel from New England could not be easier. Make your plans now by going to visitusvi.com. Learn about all three islands and plan the ideal vacation for you and your family. America's Caribbean paradise is waiting for you. So head to visitusvi.com for more information and to reserve your trip today. That's visitusvi.com.
To be engaged, you must feel included and valued. The DAV Department of Massachusetts nurtures a culture where inclusiveness is a reflex, not an initiative, where there's a deep sense of pride, passion, and belonging that is unified in our shared commitment, dedication, and patriotism for our country. We know through experience that different ideas, perspectives, and backgrounds create a stronger and more creative organization that delivers better results for the veterans and families we strive to assist. For more information, visit davma.org.
Beneficiary planning and asset protection go hand in hand, but leaving everything to your kids can be problematic. Call Cushing & Dolan at 866-848-5699 and get their new guide called How to Leave Assets to Your Beneficiaries. Don't leave your future or your children's future to chance. Call 866-848-5699 or request it online from our website, legalexchangeshow.com. The proceeding was paid for, and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and/or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated. Miss any of the show? Catch up at your convenience by visiting financialexchangeshow.com and clicking the on-demand icon, where you'll find all of our interviews and full shows. This is your home for the latest business and financial news in New England and around the country. This is the Financial Exchange Radio Network.
Ladies and gentlemen, the weekend.
This segment of the Financial Exchange is brought to you in part by the U.S. Virgin Islands Department of Tourism. Visit the U.S. Virgin Islands and enjoy your next incredible vacation. Explore St. Croix, St. Thomas, or St. John and enjoy pristine beaches, world-class dining, and fall naturally in rhythm with the heartbeat of the islands. There's no passport required or money to exchange. Go to visitusvi.com and book your trip today. That's visitusvi.com.
Joining us now is Paul LaMonica from Barron's and his piece in Barron's. This bank stock fund owns Coinbase and PayPal. The manager explains why. Paul, thanks so much for coming on, as always.
Yeah, thank you very much.
So I'll tell you, when I think most investors think of that ETF or mutual fund in their portfolio that owns the banking sector or the financial services sector, there are probably some names that come to mind, JP Morgan, Bank of America, maybe Berkshire Hathaway. I doubt most people are thinking about Venmo's owner PayPal or crypto exchange Coinbase. But as you point out, for some managers, these are growing parts of the puzzle.
Yeah, exactly. It's very interesting. Dave Ellison, Hennessy, Large Cap Financial Fund. He has, in addition to those names that you mentioned, JP Morgan Chase, Citi, all the big banks, as well as Berkshire Hathaway, he owns both Coinbase and PayPal as top 10 holdings. To put that in context, based on the last filings that we have, they are bigger positions in the fund than Goldman Sachs and Morgan Stanley. And his justification is that fintech is increasingly gaining credence with particularly younger consumers that are engaged with cryptocurrencies and are paying each other via Venmo. So that's bullish for PayPal. But with regards to Coinbase, Coinbase is obviously benefiting from the rise of Bitcoin prices this year. And because of their institutional business, not just for consumers, they are sort of the de facto NASDAQ NYSE in crypto right now. It's an exchange business. So there are a lot of fees that Coinbase generates from that business.
Shame on me for not researching this ahead of time, Paul, but I don't even know. I mean, are these companies, PayPal, Coinbase, are they in, like S&P, for instance, builds the financial services sector index? Are these companies in there? Are these big holdings when you look across the board, regardless of active versus passive management style?
Yeah, that is a great question. I'd have to look, to be honest, as well, to see if they are part of the S&P financial services sector or if they are in other sectors, be it communication services or information technology. I mean, I think the argument is that they are more financial oriented than tech, but they may not be characterized that way for anyone looking at a passive sector fund.
Paul, since arguably the Great Recession, some of these big banks have been really regulated in different ways that have killed off portions of their business, and arguably for good reason they have stepped out of these businesses. But a number of different institutions have taken that place, whether it's private equity in the lending space or, to your point, digital platforms for money movement such as Venmo. Where, I guess, is all of this stuff seemingly going, and are the banks more and more just looking like the infrastructure companies underneath the banking sector rather than the real drivers of what's next?
Yeah, I think there's a certain validity to the argument that banks are so regulated now that they could be considered slower growth businesses, sort of like utilities. But let's not go that far. Yes, you mentioned that there are now more options in the lending world. I think Blackstone has become a big player for private for companies particularly looking to take out loans, and we have crypto companies like Coinbase and digital services firms like PayPal that are taking share from the big banks. But JP Morgan Chase and Bank of America, and then you look at Goldman Sachs and Morgan Stanley, they are still gigantic when it comes to investment banking. And you are not going to see Coinbase obviously become a company that is a competitor to Goldman Sachs for taking another company public, for advising on mergers and acquisitions. So shed no tears for the big banks. I just took a look before this hit. Goldman Sachs is hitting a new all-time high today. So this is not exactly an area where investors are fleeing for the exits because of concerns about upstart competition. I think they have learned to adapt and recognize that they just stick to what they do well, even if there is competition for deposits and things of that nature. They still have a pretty strong foothold in businesses that they're not likely to lose ground anytime soon. Yeah. I think the worry is more about competition amongst each other as opposed to competition from new rivals.
Paul LaMonica is from Barron's, joining us today to talk about the evolving nature of the financial services sector as a whole and those investments therein. Paul, thanks so much for joining us. Appreciate it. We'll talk to you again next week.
Thanks a lot. Have a good one, guys.
I have an item for Stack Roulette that I have to get to. Whirlpool is seemingly, at least in my view, completely misunderstanding Americans' coffee habits. So Americans spent $3 billion on coffee makers last year, and there is a trend out there that I myself am guilty of going to a Starbucks or a Dunkin' and loading up on an afternoon coffee on many a day. And they seem to be interpreting that somehow into Americans wanting a $2,000 countertop coffee maker. And I just don't know who's going to do. So my explanation of why people go to Dunkin' Donuts at Starbucks in the middle of the day to go get up that coffee has nothing to do with the quality of the coffee, although that's certainly, expected. It has everything to do with wanting to get away from my job for 20 minutes and go and, do something that's considered acceptable. And buying a coffee halfway through the afternoon is a little bit more acceptable than sitting in the parking lot and smoking a cigarette these days. So that's the path that people go towards. So maybe this thing's going to sell like hotcakes. It is a pretty good economy right now, but
it's not.
KitchenAid, I think you might be missing the point on this, and I don't know who needs or wants or is willing to shell out $2,000 for a coffee maker.
Rich people.
There's just not enough.
There have to be.
This is not the fashion statement that I'm looking to make.
Can't they have one high-end item in their lineup, even if they only sell 1,000 a year?
Yeah.
Helps the brand? I don't know. I'm just being contrary.
Yeah.
Not to mention, it's not like it's really the smallest looking thing there. It's
Okay,
kind of
they don't
obnoxious.
just bring this stuff to market haphazardly. They
did some research. Yeah,
they asked probably McKinsey, and they gave them a nice bound report.
Again,
there's a market for
my disagreement is not about whether or not people will buy it. I'm sure they will. You're probably right, Mark. If you put enough of these things,
just
in.
500 a year.
What's that?
Yeah,
you can put it on. One of those buy now, pay later systems. You'll barely notice it. What's that really fancy? It's got like a French name. The store where you go and buy really expensive hardware for your kitchen.
It's expensive. I don't know.
Sur le
table. That's not expensive. That's it's not that.
Middle of the road.
Yeah.
You're not going to sell this here. Okay. I don't buy very high end items, as you can tell.
I mean, they have high end items, but it's
Nor do you
kind
speak
of
French,
a
as we
everyday
can tell.
kitchen place.
You didn't like sur la table.
That was actually très bien.
That is all the time that we have for the Financial Exchange this week. Have a fantastic weekend. Go Bruins. NASDAQ still leading the way up, 317 points, 2%. Have a great weekend, everybody. We will catch you on Monday for the Financial Exchange.